So now that we've got our numbers inputted into the spreadsheet, it's time to see what we've got. So the first tab that we come to is the income statement. Like I said, the income statement in pro formas I think is the most important because it's going to tell you whether the business is going to be profitable. We can see the first year isn't looking too good. No surprise there because our cost of goods sold were greater than our sales price. It was just, if you will, one of the deals, the way things were shaping up, that were just going to cost us to get the business underway. And frankly, it's not uncommon to sell stuff at a loss in your first year. That's why you have to raise money. That's just an essential part of getting going. So the first year, I know I'm already a loser when my gross profit is negative, and then when I add in all the other operating expenses, it appears that I lose just under $1 million the first year. Year two, though, looks a lot better. I'm now selling at a profit, so I have a gross profit with 46% margins. I still have all these other operating expenses, but my earnings before interest and taxes, or EBIT is how that's abbreviated, is $2 million. And in year three, it approaches $3 million. So that looks pretty good. Onto the balance sheet. And like most startups, particularly ones where so much of it's outsourced, to be honest, there isn't a lot of interesting things here that I would look at on the balance sheet. Cash flow is a different story. Cash flow, you can see it looked like I was losing just under $1 million, but from a cash flow perspective, it shows that I went a little over $1 million into the red. Year two, I come out. I should come down here, cashed end of year. Year two, I come out of the red and then continue to build nicely beyond. The reason these numbers keep going up, even though there's, I've got a funny net earnings thing in there, but it really has to do with the accounts receivable that get paid in that fourth year. I don't know why that's hanging out there. It doesn't matter. Break-even analysis, I don't use this personally. You could play with this and see what you get out of it. But the real thing you want to pay attention to is not those summaries, but the month-by-month calculations. So this is your income statement month by month. Notice the spreadsheet follows the textbook guidance in that it does the income projections for the first 2 years on a month-by-month basis, and then on the in the third and subsequent years, 3, 4, and 5, does it quarterly. So it follows the convention. And this starts to give you a sense of what your burn rate is, although your cash flow statement's a better place to calculate that. And so got net earnings here. So this gives you a sense of what your burn rate is, but you're going to see it looks a little different when we look at the cash flow statement. But this is a nice thing to try to figure out as we go forward. The one that I really pay a lot of attention to, though, is the cash flow statement month by month. And here you can see, because of our accounts receivable, the cash picture looks a little bit different. This is the way this particular spreadsheet program makes the adjustments in the accounts receivable. It does it on a quarterly basis, or not quite quarterly. I guess I can't explain exactly the basis it does it. It's an assumption. It works. You could certainly go in and play around with that and reprogram it if you so chose to do so. But this gives you a sense of where your cash is really going. Notice it matches the annual cash flow statement that says I go 1.8 into the hole at the end of year one. But then I see something very important when I come down to year two. Because it does an adjustment in this first month in my accounts receivable for my higher sales margin, it shows that I actually lose money from a cash flow perspective. I'm still cash flow negative in month one. And that means that I need, based on these numbers, a cash cushion starting of at least 1.1 million, or at some point in here, I'm going to run out of cash. What happens when a startup runs out of cash? Well, the the metaphors people use is cash is like the blood of a startup or the heartbeat of a startup. And if you run out of either one of those things, you're dead. You may have a very profitable business, but if you try to grow too fast, you may run out of cash and you're dead unless you're able to raise money through somewhere else. I wish we had more time to work examples, but I would show you how a company that on the income statement is very profitable can easily become bankrupt because it's growing much faster than it can afford, and it has to do with the length of the cash conversion cycle. So if you have to spend money to make the product well before you get paid, that's going to become a problem for you down the line as your business grows. But I pay a lot of attention to the cash flow statements month by month because those annual roll-ups can hide the fact that, hey, I was cash flow negative this month and then became cash flow positive in month 14. Also, this shows me where do I actually hit break even from a cash standpoint. It's out here in month 9 of year 2. So what would that be? Month 21, I guess. We actually have brought in more cash at this point than we've pushed out the door. These are important things when you go to pitch your deal to investors that they're going to want to know. When are you going to go cash flow positive? When are you going to reach break even? Those are important numbers for them to figure out how cash efficient your business is. So there's some other tabs you can choose if you wish. I don't personally. This is a summary tab where it has some elements of both the cash flow statement, the income statement, the cash flow statement, and some other things from the balance sheet. These stand for valuations. These are various valuation techniques. Again, fairly complicated. I don't use these. You're welcome to try for your solar shield analysis, but I find it easier for me personally just to work them down in the margins of the sheets is where I do my valuation considerations. So this has been a whoosh introduction to the spreadsheets, the mechanics of how you use them and input the data, and then how you interpret them. You may want to back up and watch this video again to try to capture this stuff, because I would normally spend the better part of an entire class period working through these, just building in some repetition to help people understand it. And we'll do a little bit of repetition on some other points, but you may need to provide your own repetition by watching these things again. In the final video, I'm going to talk about the actual solar shield case analysis that I want you to do. Join me for that.